Welcome to the deep dive. Today we're really cutting through the noise, getting into a massive 7-chapter research guide. It's focused on a company that's, well, a critical piece of the financial plumbing. Jack Henry Associates, ticker JKHY.
Yeah, and this deep dive, it throws up a classic value investing puzzle right away. We're basically asking, is JKHY this tech provider for community banks? Is it this super stable, indispensable powerhouse with a huge moat?
Or is it maybe a bit of a technological relic,
Yeah,
facing potential disruption from all the faster fintechs out there?
exactly. And the market? Well, the market seems to be leaning towards that relic idea, doesn't it?
It really is. As of our look on October 6, 2025, the stock's trading around $146.26. But our models, they're pointing to a pretty big disconnect between that price and the actual quality.
Conservative estimates based on the fundamentals put the intrinsic value somewhere between, say, $165 and $185 per share.
So that's potentially a 13% to 26% margin of safety if those numbers hold up.
Right. So our mission today is to walk you through these 7 research chapters pretty quickly, help you understand why a company that looks this solid on paper is trading at such a discount. Let's dive right into chapter 1, business understanding.
Okay, first thing, JKHY isn't a bank itself. They're the tech guys behind the banks, specifically B2B tech for about 7,400 community banks and credit unions. They pretty much run the back office.
We often call it a kind of high-margin toll road. These smaller banks and credit unions, they have to use this core software just to function day to day. It's not really optional.
Right.
And the result for JKHY, incredible stability, something like 92% of their revenue is recurring, highly predictable. It often comes from these really long-term contracts, think 7 years, sometimes even more.
7 years. Wow. That's sticky.
It's the definition of sticky revenue, and it gets reinforced by their main product areas.
Yeah, the 3 core segments. First is core processing. That's like the bank's central nervous system, right? The ERP system handling deposits, loans, all that crucial stuff.
Exactly. Then there's payments. That's a faster growing area, covers, debit and credit card processing, mobile bill pay, getting hooked into real-time payment networks.
And the third is complementary solutions. Sounds like a bit of a catch-all.
It kind of is. It's this huge library, like over 100 different integrated tools, things like fraud detection, digital banking platforms, risk management tools. But the key thing is how they all work together.
Okay.
Once a bank is using JKHY's core system, they're really incentivized, sometimes almost forced to buy the payments and these complementary bits from JKHY too. It just deepens that lock-in effect.
Got it. So they might be smaller than, say, Pfizer or FIS, but in their specific niche, these small and mid-sized banks, they really dominate.
They do, and their value proposition is clear. They let these smaller players offer sophisticated stuff, like mobile banking or real-time payments, without needing a giant internal IT shop.
Which brings us back to that moat you mentioned, the switching costs. The research used this great analogy. Changing your core banking platform is like open heart surgery for the bank.
Yeah, that really paints a picture, doesn't it? It hammers home why customers tend to stay put. High retention.
So how do they handle all the new fintech stuff then?
Well, what's interesting is they don't really fight the fintechs directly. They act more like an arms dealer for their bank clients.
An arms dealer. Okay.
They go out and acquire companies with modern tech-like pay rails for AI-driven payments or Victor technologies for embedded payments, and then they integrate that tech into their system so their community bank clients can stay competitive against the big guys.
Okay, so the business itself sounds incredibly sticky, well-positioned. But who's actually running the show? Let's get into Chapter 2, Management Evaluation.
Well, looking at the leadership, there's strong internal continuity. The CEO, Gregory R. Adelson, he took over mid-2024, but he'd been with the company a long time. Suggests stability, business as usual.
And the CFO.
Mimi L. Carsley, she brings some serious financial expertise, notably from a background at Microsoft, so a seasoned team.
And how are they using the company's money? Capital allocation?
Seems very disciplined, conservative even. They invest heavily in R&D, about 14% to 15% of revenue, which is quite high for this sector.
Right.
And when it comes to M&A, they focus on these strategic tuck-in deals like that Victor Technologies acquisition, small, low-risk additions rather than huge, transformational, and often risky mega mergers.
And what about shareholder returns?
Well, they're a dividend aristocrat. That's a big deal. Means they've hiked their dividend every year for at least 25 years straight.
And JKHY?
They've actually done it for 35 consecutive years.
Yeah.
And they manage it well. The payout ratio is sustainable, around 36-37%.
Okay, impressive consistency. But you mentioned a metric earlier that really highlights the quality here. ROIC.
Yes, return on invested capital. This is where JKHY really shines compared to peers. Their normalized ROIC is exceptional, usually in the high teens or low 20s. The report cites 20.02%.
And how does that stack up?
It blows the competition away. Pfizer is around 11.95%, FIS about 11.32%. So JKHY is generating almost twice the cash return for every dollar they reinvest back into the business compared to their main rivals.
Wow, okay. So that 20% ROIC, what does that tell us about management?
It points to really superior operational execution and probably a genuine, durable competitive advantage. They're just much more efficient at deploying capital.
And that efficiency is built on a rock-solid foundation, financially speaking.
Absolutely. A fortress balance sheet. As of the end of fiscal year 2025, their debt-to-equity ratio was minuscule, 0.02, and maybe even more importantly, zero debt on their credit lines.
Zero debt. In this environment, that provides massive flexibility, doesn't it?
Immense strategic flexibility, which is crucial. Okay, so let's connect these quality points to the valuation puzzle. Let's talk Chapter 3, financial analysis.
All right. So the performance, it's defined by steady, durable growth, right? Revenue grew, what, about 7.2% in fiscal 2025?
Yep, consistent mid to high single digits. And net income showed a clear upward trend, hitting $455.7 million in FY 2025.
And profitability.
Outstanding. Gross margin around 42.7%, and the net profit margin was 19.19%. Nearly 20 cents of every dollar in sales drops to the bottom line. That's very efficient.
And they turn that profit into cash.
They do. Free cash flow generation was a record $410 million in FY 2025. Now, when you value a high-quality company like this, one that consistently reinvests and grows, well, simple metrics like PE aren't always the best tool.
Right, the PE is about 23.44 TTM, a slight premium to the industry, but you're saying we should look deeper.
Exactly. We really need to use a discounted cash flow model, the DCF, because it focuses on the present value of all the future cash the business is expected to generate. And for a quality compounder like JKHY, that long-term cash generation is where the real value lies.
Okay, so running that DCF, what assumptions go in?
We use pretty conservative assumptions, actually. A free cash flow growth rate of about 6% to 8% going forward, and a discount rate of 9%, reflecting the quality but also some market risk.
And the result?
It brings us right back to that estimated intrinsic value range we mentioned at the start, somewhere between $165 and $185 per share.
And there it is again, the big disconnect. We've laid out the case. High quality, zero debt, 20% ROIC, sticky revenue. Yet the stock is trading well below that calculated value.
Precisely. Why is the market seemingly ignoring all this quality? There must be something else weighing on it.
That is the key question. Let's explore the market's view in Chapter 4, Market Sentiment.
Okay, so Wall Street analysts, they seem kind of conflicted, honestly. The consensus rating is just a hold, which is interesting because
their price targets are actually much higher.
Exactly. The average analyst price target is right in our intrinsic value range, $175 to $185. That implies, potentially 20% or more upside from the current price.
So they see the undervaluation on paper, but they're hesitant to actually recommend buying it. Lack of a catalyst, maybe?
That seems to be it. They see the value, but maybe not what drives the stock higher in the near term, and that caution, it's reflected in the stock chart.
The technical picture, yeah. It's clearly bearish, isn't it? Trading below both the 50-day and the 200-day moving averages.
Right. Confirms a sustained downtrend. It suggests that bigger macro worries or maybe industry-specific concerns are overshadowing the company's solid operational results, like strong earnings or that Victor Tech deal.
Is there much short interest, people betting against it?
It's moderate, around 3.85% of the float. Not huge, but it confirms there's a measurable group of investors out there with a bearish view.
Okay, so the market's cautious. What about who actually owns the stock? Let's look at Chapter 5, ownership structure.
Well, it's dominated by institutions. Over 98% of the shares are held by big players like Vanguard, BlackRock, State Street, the usual suspects.
So it's a core holding for many large funds, a blue chip name.
Definitely. And that heavy institutional ownership, especially the passive index funds, it creates what we call the index fund effect, meaning you have a large chunk of the shareholder base that buys or sells based on index inclusion rules, not necessarily based on whether the stock is cheap or expensive fundamentally. They're somewhat price indiscriminate.
Okay. Which could maybe contribute to the stock staying undervalued for longer.
It can sometimes. But here's something else that stands out, especially for value investors looking for signals: insider activity.
Right. Who knows the company better than the insiders? What are they doing?
Well, overall, insider ownership is pretty low, only about 0.60%. But the more telling point from the research is a pattern of insider selling back in mid-2025. This included some key executives.
Selling. Okay. But critically, was there any insider buying at these lower prices?
And that's the key signal that seems to be missing. We see the selling, which could be for various personal reasons.
Sure. Diversification, taxes.
Right. But we don't see any corresponding buying, even when the stock price is down here, seemingly well below what our fundamental model suggests it's worth.
So if the stock really is 20% undervalued and the management team is experienced, why aren't they stepping up and buying shares personally? That feels like a potential red flag, doesn't it?
It's definitely a critical piece of information that's absent. It doesn't automatically negate the value case, but it does suggest that maybe the insiders don't see a compelling near-term bargain either. It sort of reinforces that cautious hold sentiment we see from Wall Street.
Okay, that lack of insider conviction must tie into the risks the market is worried about. Let's unpack those in Chapter 6, Risk Assessment, SWOT.
Right, so the strengths, we've covered those. That great ROIC, the recurring revenue, the zero debt. Opportunities exist too, like helping banks migrate to the cloud, more cross-selling, especially with payments as a service.
But the threats, what's the big one?
The primary threat, the one that seems to be really fueling this market pessimism, is banking industry consolidation.
Okay, so small banks merging or getting bought out.
Exactly, and this is the main driver of customer churn for Jack Henry. If one of their community bank clients gets acquired by a larger bank that uses a competitor, like Fiserv or FIS,
JKHY loses that client.
they lose that client. The research calls it deconversion revenue. It's a direct hit to their customer base, eroding it over time, and it's largely outside of JKHY's direct control.
So an acceleration in bank M&A activity is a direct headwind for them.
It's arguably the most significant risk factor. Then you have longer-term potential threats, like maybe fintechs eventually finding ways to bypass these core systems altogether, although that seems further off.
And just general economic risks.
Sure, macroeconomic headwinds. If high interest rates persist or you have geopolitical issues, the source mentions hypothetical 2025 tariffs, for instance, that could cause banks to tighten their belts, maybe slow down their tech spending. That could impact JKHY's sales pipeline, even with their sticky base.
Okay, so putting it all together, let's move to Chapter 7, Conclusion.
Right, let's synthesize. We've really defined the two competing narratives here.
On the one hand, the bull case. You've got undeniable quality, best-in-class metrics like ROIC, that fortress balance sheet with zero debt, highly predictable recurring revenue, and a calculated intrinsic value based on cash flows between $165 and $185.
That's the quality and value argument. But the bear case counters with growth is perhaps mature, not explosive. Market sentiment is clearly negative, technically speaking, and there's that very real, significant risk of customer churn driven by forces outside their control, that banking consolidation trend.
So the final outlook comes down to weighing those two sides. The current price, around $146.26, is below that estimated intrinsic value range.
It is. The investment decision here is a classic value investing scenario. It really hinges on your personal assessment of that consolidation risk. Do you believe that risk is severe enough to justify the current discount to intrinsic value, or do you think the market is overreacting?
It requires patience, definitely, and conviction in the long-term quality, despite the near-term headwinds.
Absolutely. And maybe one final thought to leave you with, connecting back to that risk and their financial strength. Given that JKHY has zero debt, this incredibly strong balance sheet, could they, at some point, decide to use that strength offensively? Could they perhaps execute a strategic acquisition themselves, maybe targeting a rival platform, specifically to mitigate that consolidation risk? To become the consolidator rather than the consolidee. It's a big strategic question mark, but something worth considering given their financial firepower.
That's a fascinating point. Using that balance sheet, not just defensively, but aggressively. Something to definitely mull over. Okay, thank you for joining us on this deep dive into Jack Henry & Associates.
My pleasure.
If you want priority access to deep dives like this one, covering every single S&P 500 stock, consider joining our membership. It's just $4.99 a month. Members get priority access to ticker requests, and like I said, we're systematically working through the whole S&P 500 over the next few months. Or if you just want a one-off deep dive on a specific stock, dropping us a super thanks is always appreciated.
Yeah, we look forward to digging into more companies with you.
And one final important note. This analysis was generated by an AI system. It's intended for educational purposes only and should absolutely not be taken as financial advice. Always do your own research. Or better yet, consult with a qualified financial advisor before making any investment decisions.